This is the weekly economic and market update for the week ending December 9th, and I look forward to December 12th. I want to start this out by bringing up the potential black swan event that, or maybe just additional problems that could lead to the market blowing up at some point. It's just one more thing that's could potentially break the camel's back, and that would be our economy and our markets. But it is this $80 trillion blind spot. Now, it's been reported on pretty widely uh, this past week as it was uncovered. And basically, what it is, and I'll just read this, it says, according to the Bank for International Settlements, the massive debt pile of this $80 trillion in hidden debt is tied to foreign currency swaps and represents repayment obligations between different financial institutions that have yet to be settled. For example, a foreign investment firm that wants to buy U.S. assets, like a U.S. listed stock, would first have to convert their foreign currency to U.S. dollars, often via a foreign currency swap, and then buy the asset. But for as long as the foreign investment firm holds onto the U.S. based asset, there's an ongoing currency obligation it owes until the trade is closed out. And that obligation is recorded off the balance sheets of financial institutions. This makes it difficult for central bank policymakers to fully grasp the potential demand for U.S. dollars amid a volatile market event. While the obligations are relatively safe, we've heard that before, short term and backed by hard currencies, it could still be vulnerable during periods of high stress in the market. FX swap markets are vulnerable to funding squeezes. This was evident during the Great Financial Crisis and again in March 2020 when the COVID-19 pandemic wrought havoc. For all the differences between 2008 and 2020, swaps emerged in both episodes as flashpoints, with dollar borrowers forced to pay high rates if they could borrow at all. So there you go. Another $80 trillion. Let's see, the U.S. has 31 trillion. The rest of the world has a number pretty close to that. And now another 80 trillion to add on to it as potential powder keg to the markets imploding. So I just thought I'd bring it to people's attention. That's how I wanted to open this, that, this is a potential, maybe it's not a black swan because it was there in 2008 too, and created additional havoc. I'm sure there will be other things that as markets deteriorate and the Fed over tightens that will start to show themselves. It's like lowering the water, and all of a sudden you're finding all of these problems and issues when things aren't running very well, and on purpose. So we'll see what happens. All right, let's move on to the investor sentiment. And actually, after pretty much not moving at all, and not much of a movement, but 41.8% bearish as of Wednesday. I know I always mention this, but on Wednesday night, this figure comes out. May have changed a little bit since then, but 41.8%, at least at that point in time. And that is an increase of, 1% or a little more than 1%. Bullishness has increased a little bit. I'd like to see this kind of continue to tick down because I like to be greedy when others are bearish. But that's where it stands this week, and it will just follow along here as things unwind. Okay, the fear and greed index for investors, it's moved from greed to neutral this week, or ended on neutral this week. And I think people, it's kind of where I stand too, which is, is it going to go up? Is it going to go down? who knows? And if you don't know what to do, then a lot of people need to be probably sitting in cash, and until they understand some of the tools that you can use. I'll talk a little bit about that at the end of this episode. This week, as far as the economic calendar, we had very little activity, as I mentioned last Friday. The manufacturing PMI came out a little bit hotter than was expected, and that actually helped drive the markets down initially. And the balance of trade, I'm not bringing that up at this point. It'll become important later, but it's not a market mover right now. The PPI was another thing that was brought out. It came out hotter than expected. The markets reacted negatively to it, and then it wound up kind of making a little bit of a comeback after an initial, downward move. And then the Michigan consumer sentiment. Now, that was an interesting move because it initially moved down quite a bit and then it moved back up. But we closed the day down, I'm going to say the last 2 hours of the market today closed down probably a couple hundred, maybe even 300 points from where it had kind of sat the whole day, kind of sometimes, being positive, sometimes being negative, and then things kind of fell apart at the last minute. Next week, we have the CPI on Tuesday, and now this is firework week as far as I'm concerned. And firework week to me means that I expect things to move up or down based on what some of these reports did. Now, if you remember, not too long ago, the CPI came out and was less than what was forecast or expected, the consensus. And just take a look at this. So it's expected to be 6.5%, came out 6.3%, and the market exploded. 6.1, 6.2 is a forecast. If this thing comes in lighter than that, let's say, especially if it's 5.9 or less, the markets are headed up. If it doesn't, then it's going to, get or something worse. Then you're going to see the markets go down. So, in other words, if it gets to 6.4, 6.5, 6.6, something like that, the markets are going to go very negative. Now, one of the things, let's see, did I cover? Oh, well, the other thing, obviously, is the Fed decision. So the next day, they'll have seen, obviously, the CPI, and, we're expecting a 0.5 point raise. Now, if the Fed does anything different than that, then it's going to have a positive or negative reaction in the markets. So if the Fed raises more than 0.5%, let's say they go 0.75%, then that's going to be a negative for the markets. And if it goes less, at least initially, it will be very positive for the markets. And they're expecting the 5.5% increase in the Fed funds rate, and as long as they don't move from there, everything will be relatively calm. So the real big thing, real fireworks, going to happen with CPI. The retail sales has a tendency to move the markets a little bit. It's been running hotter than expected, but it is a negative if it runs hotter than expected. So last month they expected a 0.2% decline. We got a 1% increase and got 1.3. Here we're expecting a decline of 0.2%. So if it's above that, then you're going to find that the markets will move negatively. Let's go to some of these key market measures. The 10-year went up this week from about a tenth of a percent. I like to see it start moving down. Now it's not going to go down a straight line, but it has been definitely trending in a downward fashion here. And the lower this goes, the better it is for us. It's kind of broken this trend line, it looks like, a little bit, but it's not going to move up and down in a straight line. So the fact that it's broken this is a little bothersome. The DXY, again, another measure I keep an eye on, has been hanging out just kind of all week around the 105. This is the US dollar index. And my expectation is that it will continue to go down. Some are still expecting it to maybe go up to 109 or so before it starts heading back south. Anything below 105, you get down to 103 is kind of the next level I have pegged for it to break. But it could go back up. And again, these are negative things for stocks if it goes up. The dollar, the 10-year yield. The crude has continued to back off. We're in a downtrend, definitely. Lower lows and lower highs. So we're in the process here of oil going down. Again, you could get a spike in association with international factors or any of a number of combination of things. Now, I mentioned last week that the Dow Jones I felt the markets would be pretty flat to down this week. It kind of lived up to that. Today was a little bit of a surprise at the end, going down 200 or 300 points right in the last 2 to 3 hours of the market. And the SPY kind of did the same thing. And so I'm looking for numbers that they didn't break any huge levels. It broke the trend, the downward trend here, but it didn't break the significant levels I've been looking for. It just kind of seems to be consolidating a bit, and I think that next week we'll break that. It's either going to go down. My expectation would be it goes down to 380, or that we start our way back up and we start hitting numbers maybe as high as 420 before we start to relook at it. So that's kind of my expectation there. Now, what I wanted to mention was that the way I play these, and this is kind of my final comments, is I've been playing these as straddles with short expiration dates. So in other words, before Tuesday, with regards to DIA, which is Dow Jones Industrial, or the SPY, they typically will have, well, I know definitely SPY will have expiration dates almost every day of the week. So for your options. And so I play a straddle, and I've put out a video before, and I'll put a link to it on this video that you can get to. But you can definitely, if you understand how a straddle works, then it's something to consider. This isn't a trading call. It's just more of here's what I'm going to do. Before Tuesday, Monday night, probably, I'm going to place one call or buy one call. I'm going to buy one put. And my expectations that will be, and I think they're running right now around $8, that we'll get an $8 move, and I don't need the whole move, but an $8 move either up or down on the market for that day when the announcement comes out. The only thing I don't want it to do is stay where it is. And typically it hasn't done that. So it's just one of the ways I play some of these economic news that come out. And if the CPI goes down, it won't matter. I win as long as it moves. If it goes up or down. And like I said, you can watch the video and see what's there. Now I probably will make this plea every week for people who watch my videos, and that is, please educate yourself. And like I said, I've been putting a link in to Chris at ProjectFinance. I'll be adding these are free resources. It's probably an investment of your time of probably an hour to go through it if you play it a little faster, which you can do on YouTube. Um, you know, it will make you a better investor. It will show you some additional tools that you can use in your part of your financial education, I guess, is what I would say. I do want to find a resource out there, a free resource for technical analysis and fundamental analysis that people can use. And again, free resources, a lot of free stuff. Not all of it's good. Some are better than others. Chris at ProjectFinance does a good job of giving you the fundamentals, but he's not going to give you the strategies associated with it. And I think, and that's the thing about investing. Everybody is different, and that's why it's virtually impossible for me or really anyone to give you trading advice, because I'm going to trade different than someone else. It's just like different personalities, tolerance of risk, who you are as an individual plays very well. And everybody has biases, and they're different for every person. So it's something that's very personal when you get into trading to figure out what works for you. But I am a strong advocate that people should start making themselves aware, and that by next year, if we get the collapse that I'm looking for, that you'll know how to play it. Because if if the markets have always had associated with it, they always go up, but I don't think necessarily that that's going to be the path here, possibly for at least a decade or more. And so how are you going to make money if the market's not going up? You're going to have to find other ways. Now, certainly fundamental plays with dividends is one way to do it. There'll be avenues to do it, and it's also going to be switching to categories of things. Like everybody was tech before. I don't think tech's coming out of the bust is going to be something that is going to be the hot thing to have as far as stocks go. It'll be other things in there, and you're going to have to be really educated in doing it. I'm doing everything I can right now to educate myself, and I just encourage people to do that for themselves. I just wish I didn't, but all I see is not good news every time I turn around as far as the long-term effect on the U.S. economy. So that's what I wanted to cover this week. And remember, there's always a better way.